Hey guys, it's Davey, your friendly neighborhood taxman, back again to answer your accounting and tax questions. So in today's video, I thought we would take a bit of a break from the usual style of videos and answer a few FAQs that our friends at Sprint Law get asked quite often. They're questions around business structures, record keeping, tax, and company admin. So Sprint Law is pretty good at tackling the legal stuff that comes with running a small business. But I thought I'll be a good fit for these specific accounting and tax related questions. Surprisingly, I get asked a ton of those legal questions too. So Sprint Law team is also doing a video to help our viewers get grips with the concepts like intellectual property, business contracts. So make sure to stay tuned for that one. But for now, I've covered a list of the 6 common questions that small business owners ask. I've saved the best ones for last, so make sure to stay tuned. Okay, so let's jump straight into the first popular question that seems to pop up, which is all about business structures. You all want to know what the key differences are between the various business structures. So here are a few things you should look out for. I'm going to assume you know what a sole trader, a company, and a trust are. So I won't go into detail about the definitions of each, but basically you can use any of these structures to run your business, and they're definitely the 3 most common ones. The first key difference is the tax implications, the income tax rate that is different for each structure. For sole traders, their personal tax rate determines their obligations. The higher your taxable income, the higher your tax rate. Generally, if your income is in a lower bracket, so below $45,000, your tax rate is either 0 or 19%. Once your income is anywhere between $45,000 and $120,000, your tax rate increases to 32.5%. And if you earn over $180,000, your tax rate can go up to 45%. With a company structure, the tax rate is a flat 25% for most small businesses. And with a trust, it actually depends on the beneficiary tax rate. So if the trust beneficiary is an individual, then most likely it's similar to a sole trader. And if the beneficiary is a company, then most likely it's similar to a company, 25 to 30%. These numbers also change around every year, so make sure you check the ATO's website for specific numbers. The second key difference has to do with the ownership and responsibilities. Sole traders own and run their business in their personal name, so they control the business and they're also responsible in their personal capacity for the business debts and liabilities. Companies are controlled by the directors and owned by the shareholders. A director is not necessarily a shareholder and vice versa. Directors control the business and have certain responsibilities. Shareholders can receive profits as dividends. And then there are trusts. Trusts are similar to companies in that the trustees of the company control the business, and the beneficiaries are the ones that benefit from the profits. Okay, so the third key difference has to do with costs. A sole trader has a relatively low setup and accounting costs because it's relatively simple structure. So I would say you should expect to pay anywhere between $300 and $1,000 each year in fees. A company and trust structure are less straightforward and comes with slightly more complex administration and obligations. So you can expect to pay up to $4,000 each year in accounting fees. However, this normally doesn't even include bookkeeping fees as well. Next, we have the distribution of profits. Sole trader profits can't be distributed to other family members or anyone related to business that is not the sole trader. So it's not a flexible structure. Whereas with companies, the profits can either be distributed to the shareholders or retained within the company. But if you choose to distribute the profits, you have to pay the profits as per the shareholder holding percentage. Trusts are different in that they must distribute all the profits to the beneficiaries each year. It can't be retained in the trust at all. For discretionary trusts, the trustee has control on what percentages to split the profits amongst the beneficiaries each year. This is generally the reason why the businesses choose to set up a trust as part of their business structure. So those would be the 4 key differences I'll be keeping an eye out for. I'm a big fan of companies, so there's definitely a bit of a bias in my recommendations, but another option to consider would be to combine the concept of a trust and a company. So basically, you could set up your business structure as a trust, then have it own the shares in the trading company. Let's say you own 100% of the shares of the trading company in your personal name, And if that is the case, then you would likely have to retain the profits within the business. This is mainly because to get that profit out of the company, you will have to pay it out to yourself, which means your tax rate will likely be super high. But if you pass the profits to a trust, you could distribute the profits to a beneficiary each year, or multiple beneficiaries. The main reason I would suggest doing this is if you're looking to distribute profits to your family members or anyone related to the business, you can't do this with a company structure. And having the flexibility to distribute profits to beneficiaries when it comes to specific tax planning and asset protection, it's actually really beneficial. Look, it will require a little bit of extra work, especially when it comes to working out how the profit will be split. So I would definitely recommend speaking to your accountant about this to see if it makes sense within your context of your business and your financial circumstances. Okay, on to the next popular question. What do you need to do after setting up a business or a company? Once you set up a company with ASIC or any other online provider, you'll receive an Australian company number, also known as ACN. This helps you identify your company. You will then need to set up an Australian business number, ABN, and a tax file number, TFN. The ABN is a unique number that allows the ATO to identify your business. The tax file number is a unique number that allows you to report your taxes, such as your income tax and GST. Remember, not to get confused with your own ABN or TFN because your company has to have its own. And then recently, the government has also announced another number that you have to set up, and that is the Director ID number if you're a director of a Pty Limited company. Also, don't forget about setting up a separate business bank account for the company. Don't go using your personal bank account for running the business. Rather, best to keep all your business transactions separate from your personal bank account. Once you have all these things set up, I also recommend setting up the business on an accounting software, which will help you send invoices, run your business, assist in reports, and pay your taxes. The third question on the list is whether or not you need to appoint separate directors, shareholders, company secretaries, and public officers, or if they all could be the same person. Okay, so as part of the company regulations, you need to appoint a director, shareholder, and public officer. The company secretary is optional. As I mentioned earlier in this video, the director or the directors run the company and the shareholders own the company. The public officer is the company representative who has to make sure that the company conducts itself according to the income tax laws. And then the company secretary is responsible for the company administration. So things like making sure the company is compliant with statutory and regulatory requirements. They also generally ensure that the decisions of the board of the directors are implemented. Now, regarding the question, yes, all these roles can be fulfilled by one person. But it's best to speak to a lawyer and accountant to get the best advice for setting up a company. It can cost money to make changes later, so it could be good to get professional advice first. Okay, now on to a very popular question. What is GST and PAYG withholding tax? So once you've set up your business and you start turning over at least $75,000 in sales each year, you must register for goods and services tax, or GST. It's a 10% tax levy added to your business sales. So you'll be responsible for charging the GST on top of your sales, then you have to pay that directly to the ATO. Pay-as-you-go withholding tax, or PAYG withholding, has to do with your employees. So once you start hiring employees or paying yourself as a director for a company, you need to register for PAYG withholding. This will allow you to record the taxes you need to pay to the ATO on behalf of your employees when paying them the wages. Both GST and PAYG withholding are reported in business activity statements and are lodged quarterly, but sometimes monthly or even annually. These get tricky, so if you have no clue about these taxes, it's best to speak to an accountant or a bookkeeper to help you out. And the fifth question on the list is all about record keeping. How exciting! What records do you need to keep for your business? Well, this is a really good question because record keeping is super important. First-time business owners generally don't bother with this, and it causes so many issues and delays down the line. So stay on top of this. You must keep all the following documents for at least 5 years. All of the receipts and tax invoices for your business purchases, sales invoices, wage records, contracts, and agreements related to the business, business bank accounts, business bank statements, tax returns, business activity statements, and superannuation statements. You don't need to save these in the accounting software, but just make sure it's easily accessible. And finally, I've saved the best question for last. What are your tax compliance obligations? I know taxes can be quite confusing, but here are the main obligations you need to meet. As a small business, you will generally have to deal with 3 different reports: your business activity statements, your income tax returns, and single touch payroll. Your business activity statement, or BASs, deals with the GST and PAYG withholding tax that we spoke about earlier. You don't need to lodge this unless your business turnover is at least $75,000 each year or you have any employees. You either need to lodge this quarterly, monthly, or annually, but I generally recommend staying on top of this each quarter. The quarters run from July to September, October to December, January to March, and April to June. The actual BAS return is usually 28 days after the end of each quarter, so make sure you lodge within 28 days. Then you have your income tax returns. So usually, in your first year that you run your business, you won't have to pay income tax straight away. This is because it's difficult for the ATO to determine your tax obligations in the first year. But on the 30th of June, after your first year of operations, you must lodge an income tax return for your business, and that's when income taxes will apply. You'll need to report your income, your expenses, your profit, and business activity, but it's generally a good idea to get a good accountant or tax agent to do this for you. Once the tax return is lodged, you'll receive a tax statement from the ATO with a total amount of tax that you have to pay. Then lastly, you have wages tax. If you hire employees, you must set up payroll software to employ your employees, calculate their taxes, pay their wages, calculate their super, and then also the net wages. This is filed with the ATO using the single touch payroll filing system on a regular basis, so ensure that your taxes and super is paid on time, or the ATO will know about it. Oh, and one more thing that you should keep in mind is that your company also has to comply with certain ASIC requirements as well. So you must keep up-to-date financial records of the business, and this can be done via your accounting software like Xero, MYOB, or QuickBooks. The company must also pay an annual ASIC fee every year to ensure that the company stays registered. And then lastly, you must update any company changes such as your address, changes to shareholders, or even changes to directors with a 484 form with ASIC within 28 days of that change. So there you have it, answers to 6 of your burning questions. I hope you found this video very useful, and if you need any accounting advice, you're welcome to book a free consultation with Box Advisory Services team. And otherwise, if you need some legal advice, make sure to get in touch with the team at Sprint Law. See you next time.